Hey, what's going on? Christian Carter, and today we are talking about refinancing your mortgage, and basically when is it a good idea and some of the reasons you want to refinance. This is going to be a little bit of a long video. I apologize for that up front, so let's get right into it. All right, refinancing your mortgage. 9 times out of 10, the goal of refinancing your mortgage is going to be to save money, right? So when is it a good idea to refinance your mortgage? We're going to go over 2 rules right here. Here's the first rule. Here's the rule that I like the most. If the interest you save will pay for the closing costs in a couple of years, then it's a good idea. So for example, if you can refinance your mortgage and you pay a lower interest rate, you pay a lower monthly payment, and you can recoup the cost of those closing costs within 2 years, yeah, probably a good idea to refinance your mortgage. All right. So the formula that I like to use, there's a million formulas out there, but this one is very, very simple, right? So the formula that I like to use is closing costs divided by monthly savings. And that will figure out how many months it will take you in order to pay back those closing costs and start seeing a financial benefit, right? So let's do a quick example. Closing costs are $4,000, right? It's going to cost $4,000 for you to refinance your mortgage. Now, 9 times out of 10, we'll roll that into the loan amount, so you don't have to go to the closing table with any money, but you're still going to pay that $4,000. It's just going to be added to your loan amount instead of you paying for it out of pocket, right? All right, so the closing costs are $4,000. If you refinance, you are going to save $400 a month. So we take your closing costs, which is $4,000, we divide that by 400, and we get 10 months, right? So that's a quick, easy example right here, that if you refinance and you're saving $400 a month, your closing costs are $4,000, your break-even point is 10 months. So that means during that, or after that 10-month period, you'll be saving a bunch of money. All right, let's talk about another thing, the 1% rule, right? So everyone's got that uncle out there that's just, the smartest guy in the world. He's a know-it-all, and he's always like, well, you don't want to refinance your mortgage unless it's you're getting a rate of 1% or more, right? That is a dumb rule, and we're going to tell you why right now. All right, so why I think the 1% rule is a bad idea. So let's say you have a loan balance of $500,000, right? And it's at 4%. You have a 4% interest rate right now, right? So that's a payment of $23.87 per month. And then I call you up and I'm like, hey, we can refinance you into a new mortgage for 3%. So you will save, let's see, so your new 3% at $500,000 will be $21.08 per month. So you're saving $279 per month by refinancing, by dropping your rate by 1%, right? That's a really good deal. So you'll make your closing costs back in a couple months, right? So now let's do the next example. Let's say you have a $100,000 balance at 4%, and then I call you up and I tell you that we can get your interest rate of 3%. Well, that's only a savings of $56 a month. So that's why I don't like the 1% rule. If you have a very high loan amount, up in the 500,000s or something like that, even little incremental drops in the rate are going to help you out. The lower your loan balance is, the bigger the interest rate drop needs to be for you to see like a real savings, okay? That's a real quick example. Now, this is kind of like, that's like the kind of the financial side. This is kind of like the real life side, right? So why do people refinance? We're going to go over some of the benefits of refinancing. So right here, switching loan programs. So a big one for this is when people have an FHA mortgage, where FHA mortgage insurance, you have to pay that mortgage insurance for the entire life of the loan. So a good reason why people like to refinance is to switch from, FHA into a nice conventional loan, maybe get rid of their PMI, things like that. Switching loan terms. So here's a real common one. So let's say you got a 30-year mortgage, right? And then you are 4 years into that mortgage. So you have 26 years left. And then you call me up, you want to refinance. We can refinance you into a 25-year mortgage, right? So you're actually knocking 1 year off the loan term. A lot of people think that you can only do a 30-year refinance, or excuse me, a 30-year mortgage or a 15-year mortgage. That is not true whatsoever. There's 5, 10, 15, 20, 25-year, 30-year. You can even get into the 27-year, 26-year, a 22-year mortgage. So that's a real common thing right here, switching loan terms, either adding on to the loan term and making it longer or shortening it so you can pay off your mortgage faster. Here's another one, credit score improvement. So a lot of times, especially with first-time home buyers, their credit is not, it's not always great, right? So what can really help you is after a couple, months or years of paying your mortgage on time in full, your credit score is going to improve, right? And, I know there's another video on here, but interest rate is compared to the risk, right? So the lower your credit score, the higher your interest rate is going to be. So if you've, been paying your mortgage on time for, a couple months, a couple years, you can refinance just because you have a better credit score, you might get a better rate. All right, this is another one that is really, really great. So again, after a couple years, you are paying your loan balance down, right? And then hopefully your home value is going up. So that is really, really great because a lot of times a refinance will help you eliminate or reduce your private mortgage insurance payment. That's the big kicker right there. We can save a lot of we can save people a lot of money by reducing the interest rate and things like that. But if we can start knocking off that private mortgage insurance, that's a big win. All right, let's see. This is a big one right here too. Taking cash out. So if you have enough equity in your home, you can take cash out to do a certain amount of things. You can pay off debt. Let's say you've got credit cards, you've got student loans, whatever. You've got a lot of debt. You can take cash out of your home and pay off that high interest rate debt. Another one is home improvements. So you're looking to redo the kitchen, add a bedroom, add a porch, anything like that. Especially adding value to the home. That's a really great reason to take some cash out. And then another one, investing in business or assets. So a lot of real estate investors love to do this. They love to take cash out of their properties so that they can use that cash to go buy another property, right? Another one is a lot of small business owners will do this as well. They'll take cash out of their primary residence and then they'll inject that cash into their business to help them grow. So, all right, guys, we're almost done. Stick with me. So next, two things I wanted to hit on. These are popular questions that I get all the time. So next, mortgage payment. A lot of people say that you can skip a mortgage payment, right? Well, you're not when you refinance. Well, you're not really skipping a mortgage payment. But mortgages are paid in arrears, right? So what that means is that, what is it, October? So we're in the month of October, right? Let's say you close on your refinance October 15th, right? So that means your next mortgage payment is not due until December 1st, right? So when you do refinance, you get a little bit of a buffer zone, a little break there. So I wanted to hit on that. Also the escrow refund. So if you have your taxes and insurance rolled into your mortgage, which 99% of people do, what you'll do is when you refinance that mortgage, you'll actually get a check back for your current escrow amount. So what that means is that you have this escrow account set up that are paying your taxes and your insurance, right, for your property. So when you refinance, you set up a new escrow account, which means, a couple weeks after you close on the refinance, you'll get a nice check from your escrow company. Usually it's a couple thousand, couple hundred, somewhere in there. It matters how big your escrow balance is. So I hope this helped. Reach out to me anytime with any questions. Like I said, I know that was kind of long, but it's really important stuff. All right, I will see you later.